Hello. For those of you I do not yet know, my name is Tim Antonelli, and I'm a portfolio manager and the head of multi-asset strategy for insurance companies at Wellington Management. A substantial portion of my job is having conversations with literally hundreds of global insurers and advising them on how to get ahead of emerging risks that will likely have an outsized impact to not only their invested assets, but also their businesses in total. In this series, we'll look to identify key themes that we believe you should be focused on that exist at the intersection of the insurance business and the capital markets. For this first segment, we're going to take a look at something that's happening with US insurers around how securities are rated for risk capital ratios. Now, the Valuation of Securities Task Force discussed in May a proposal that would give substantial leeway to the regulator to make adjustments to the ratings of select funds and securities. This is significant for a few different reasons. First, it represents a large departure from what's called the filing exempt process today, where a stated rating from a credit rating provider equates to a given capital charge, and the insurer does not have to submit anything to the regulator. Two, it places a greater emphasis on structures of securities like feeder funds and structured notes that may have higher risk and return assets embedded in them, but are presently receiving a bond-like capital charge. And three, I think it increases regulatory oversight at a much more granular level in terms of the portfolio analysis. So the proposal allows the regulator to do two things. One is to assess other non-payment risks that exist either by the fund or the security itself. And two, it allows for the concept of the regulator to notch down the credit rating provider's stated rating if they believe that it does not reflect the appropriate economic risk of the underlying exposures. So first, the responsibilities of the Structured Securities Group and the Securities Valuations Office, as we know it around these parameters, will now roll up into the Investment Analysis Office. The ratings review on a security or a fund can be initiated either by this new office or by an individual state regulator who has concerns about an insurer's positions. The Investment Analysis Office will take about 120 days or less to review the position and compare what their assessment would be relative to what the credit rating provider has laid out. An insurer can appeal at the end of this procedure if they get a result that they don't like, but they must wait for the future year to perform that. In the immediate year, they'll have a decision to make about divesting from the position or incurring a higher capital charge if the rating is notched considerably lower. Now, there is an aspect of materiality that I think is critical to mention here, where the IAO has said if their notching won't result in a 3 or more notch downgrade, based on what the CRP is calling it today, then they will not go through with a ratings review. So in summary, what does this mean for your portfolio and for what to watch going forward? Well, it does leave you potentially exposed if you are invested in some of these more unique and structured notes and feeder funds. And so I would advise insurance companies to focus more on look-through assessments when you're thinking about things like your enterprise risk, concentration limits, or measuring portfolio volatility. You could also consider using a weighted average rating factor type output where you're making an assessment on what you think the IAO might calculate if that position was to be put under review. That way you can see how far off you might be from what the credit rating exists today by a normal nationally recognized rating agency provider. We'll be continuing to watch this topic closely moving forward, as again, it will have an outsized impact on all US insurers, and you can be sure that we'll use this space and others to keep you informed of this situation as it evolves. Thank you.